We are currently experiencing a very significant market melt-up, but we will ask, will this continue? So let's find out. Okay, so hello and welcome to our most recent urgent market update video. And we're putting this out on Friday, the 27th of September. So you're probably more than aware with these global equity markets, they are continuing to make higher high after higher high on a regular basis. And we are seeing this phenomenon of a melt up in financial markets. You're seeing it in gold, and you're seeing an increase in prices as well in markets like cryptocurrencies and Bitcoin. So what we'll do is we'll break down, we'll explain, we'll try to identify whether this market melt up is actually warranted, or if it's kind of a false move. And then on the back of that, we will look to draw a conclusion and suggest, are we more likely to see prices continue higher? Might we see a very significant reversal? And if so, what would we need to see in order for that to be the case? So let's get straight into this video, this short video then. We'll start, as we always do, with our risk warning. Take a brief moment to familiarize yourself with our risk warning currently up on screen. Okay, so let's get straight into it then, and we'll ask the question really whether this recent price action, and if we perhaps start with the chart, you're probably aware we're in a very, very strong bullish market rally pretty much since October 2023. In fact, no, you could go back even further than that, and you could sort of things began to change around March of 2023 when this AI rally came to the fore, and we started to see, these prices starting accelerating again. Then we experienced a little bit of a weaker market dynamic before these prices really started to skyrocket, as you can see. Now we're up at these extremely high levels. We want to ask, and we're looking to the data in a little bit more detail, but the data I want you to just take note of is this candlestick here. It was quite a bearish candlestick. And then subsequently, this is on a Friday, and then subsequently the market opened on a Monday, and then started to accelerate a little bit higher. So let's firstly ask, is the data supporting these very bullish prices? And the short answer of that is yes. So if we go back to, again, Friday, September the 6th, that was when we had non-farm payroll numbers. So if we just go back a few days prior to that, there was a few concerns. Unemployment claims were broadly in line with expectations. ADP came in much, much weaker. So it really did lend itself to this weakening jobs number. And then the job opening numbers came in much, much less. So there was this expectation that these job numbers were really beginning to weaken. As a result, we saw the equity markets sell off at the beginning of September. But then look what happened with non-farm payrolls. So although the headline number came in a little bit lower than expected, this is still quite a strong employment change number. We started to see average hourly earnings come in above expectations, and a significant growth in the previous numbers, so people are earning more. And the unemployment rate actually dropped back from 4.3 to 4.2. So that was a bit of a catalyst. And as you can see, markets then opened the following Monday and started to rally. So the next question is, do we have more data that could support further upside? So if we just flick through some of these, we got to Wednesday, September the 11th. We had US inflation numbers, and we want to draw your attention to broadly the headline numbers. Some of the core CPI numbers are still looking quite sticky. But in terms of headline inflation year on year, previously 2.9, we're now down to 2.5. So we do have this lowering inflation number. We keep it moving. Looking at PPI numbers, they came in a little bit above expectations. So headline CPI coming in below expectations or in line, but much lower. PPI, a little bit of a concern on the input costs, but unemployment claims were still up at the elevated levels. There was still a sort of a 50-50 as to whether this will, accelerate to 250, 260, or, will it soften slightly? So we keep monitoring those unemployment claims. We'll move it along. We close out the week, of course, and then into the following week beginning the 16th of September, a few bank holidays, but we continue to monitor retail sales. So we had a bit of a mixed bag. Core retail sales coming in lower than expected, but retail sales coming in a little bit higher than expected. So an awful lot of nothing really around that retail sales figures. So do we have any other reasons to be quite bullish these markets as we roll into the 18th of September of this month, where we actually saw Jerome Powell and the Fed make very bold decision to not just cut rates by 25 basis points, but we actually saw a 50 basis point rate cut. So instinctively, when a central bank cuts interest rates, that broadly implies that's kind of weaker for the currency, and it's likely to stimulate and loosen financial conditions. So we can look at these charts with that frame of mind, and we can say, right, well, if we loosen financial conditions, is that bullish for these markets? The answer is yes. And if we just have a look at the dollar, and we'll say, have we seen some significant dollar weakness as a result of these loosening financial conditions? And the answer is yes. So we are firmly in a risk-on market dynamic, and it all goes down, or it all goes back really to the reasons why the Fed cut. And at the moment, the market is expecting, or is perhaps believing the Fed when they say that we are cutting rates because inflation is coming back to target. And now the focus is moving to unemployment numbers. And instead of allowing unemployment to just run away and to get a US recession because unemployment numbers start rising very aggressively, they decided to make a very, very bold statement by saying inflation's down 2.5%, like we just looked at. And as a result, we have a bit of room. If you look at bond yields, they're down at sort of 3.5%. 3.75%, somewhere in that region. So there's plenty of room for the Fed to start cutting. And that's basically what we've seen the beginning of. So we've seen, and this means a loosening of financial conditions. Now, the concern is inflation will come back strong, but there is this built-in belief that actually we're still seeing a lot of disinflation in the system. And the economic projections basically showed a series of rate cuts, not just a one and done, but a series of further rate cuts. So again, that's further evidence of further bullish rhetoric and reasons for these markets to continue to make new highs, as long as the market believes the Fed to be on the right track and we're not cutting because of the potential for a recession coming down the tracks. So we can move things along. Then we see unemployment claims fall quite considerably. And that does mean, of course, that the unemployment situation is still pretty firm and pretty solid. We'll move it along even more. We've also had decisions made by the BOJ, but that's a slightly different narrative. And that pretty much brings us into this week. So broadly, we have a series of kind of bullish data points, really, that suggests that there's no real reason why the wheels would come off the equity rally, as long as the market believes the Fed to be broadly on track with the reasons why they're cutting rates. So then Monday of this week, we had a series of manufacturing and services numbers. And as you can see, flash services in the US, looking really strong in expansion. But we do have these little pockets of weakness, and certainly flash manufacturing PMIs would be that sort of weakness really that is there and clear for everyone to see. So it's not all straightforward. Consumer confidence has taken a bit of a hit. So again, that's leaning against the bullish stock market, because 70% of the US economy is consumer driven. Now that brings us to GDP. So in order to get a recession, you need 2 back-to-back quarters of negative data. And as you can see, back in 2022, we experienced just that. They call it the silent recession because we were technically in a recession, although we closed out the year pretty strong. We just went through a bit of a blip, and all the data started to turn a little bit more positive very, very quickly. And as you can see, quarter on quarter, final GDP numbers out of the US economy is coming in at 3%, in line with expectations. That's a really strong performance for the US economy, far stronger than the Eurozone, the UK, and the Japanese economy as well. And unemployment claims have only insisted on continuing to move lower. So there's less and less people applying for unemployment. It means more and more people have jobs, and more people have money in their pockets to pay those higher prices. So it has a direct knock-on effect. We've seen a series of these central bankers as well, FOMC members, that seem to be broadly dovish, in line with Jerome Powell and the Fed. And today, just now, we've just had, just a little while ago, Friday 27th, we've come full circle, and we're continuing to see inflation in the US move lower. So all that fits in with the dynamics that the Fed have laid out, that inflation's coming down, and we're cutting rates to try and save off unemployment numbers starting to tick wildly out of condition. And some of the smaller, like the unemployment claims numbers, seem to be falling in line with that particular narrative. So that's hopefully a bit of a breakdown of some of the news events over the last month. And we're at the end of the month now. We're closing out this monthly period, and we've had a really strong September, when the expectation, if you look at September over the last 3 years, you'll see it's broadly been a negative month. And we're now seeing a really strong rally going into the US election, of course, in November. And to answer the question, we're currently seeing this melt up. So we're not necessarily saying we should be seeing, that type of bullish market. But we are continuing to see these prices continue to rise. And we expect that to continue unless something significant changes. So we'll be looking very carefully at the unemployment numbers. We'll be looking very carefully at the inflation story out of the US. We'll be looking very, very carefully at some of the growth dynamics behind the US economy. If all those stay intact, there's no reason with a interest rate, with a very dovish Fed and bringing interest rates down, that we won't see further upside in these markets. So that's the equities. Same could be applied for the NASDAQ and the Dow Jones and other markets like the CAC, the French, and the German DAX is at all-time highs as well, just absolutely flying, even though you've got a really weak German economy. So there's, as far as asset prices are concerned, we've got a very, very favorable dynamic for asset prices. And as you can see as well, we've got, very similar to the S&P, we've got gold. We made new all-time highs just a few hours ago, as in yesterday. And so the last question is really about the dollar. Well, again, since we've seen that bit of a pivot we saw a bit of early dollar strength in the early part of the month, followed by a significant amount of weakness, which is very much in line with that risk-on narrative, equities higher, dollar weaker. And we just seem to see a lot of the data flowing and moving into that narrative. So we've got a bit of a review page, so we'll explain the narrative in a little bit more detail. But what I want to do with the dollar is to just step back a little bit. We've been in a really very, very long-term bearish dynamic for the euro dollar since the financial crisis in 2008. We've seen the dollar really significantly strengthen on a prolonged period. We reached these lows of kind of 0.92, I think it was, down at these lows. and we've now bounced off those lows. 0.94. But what we're doing now is we've been in a bit of a we've been in a bit of a 2-year sideways moving pattern, and now it shows signs of beginning to break out of this range. And that's what we're going to be looking for, is continuation that the dollar is likely to weaken. And that what that really does is reaffirm the risk on narrative. So when we ask ourselves, will this melt up continue? There's no reason why that won't be the case as things currently stand. So what that means for us is we've got this risk on market dynamic. It's likely to continue because we've got a really dovish Fed. We've got this low interest rate dynamic. We've got lower inflation, just core PCE coming in at 0.1, expected 0.2. So that's coming in even better than expected with lower unemployment. So from a trading perspective, what does that mean? It means we're heading towards, we're still on track for this soft landing. Certainly there's a couple of areas of negative economic data, but broadly it's quite positive. If you're looking at if you're looking at the unemployment numbers, if you're looking at the inflation numbers and the growth numbers, it's really quite positive. And we do have this AI tech rally with markets like Facebook making new all-time highs, and many of the Magnificent Seven still in a bit of a sideways pattern, but still performing really, really well, close to all-time highs. So do bear that in mind. But from a trading perspective, that's the narrative. But what are we looking to do? Well, as long as we get risk on market dynamics, which is a very positive sentiment towards these markets, which we believe we have had, we will continue to have, we'd expect the US indices to continue to rally, the dollar to continue to weaken, like we just explained in the euro dollar, with the potential for the euro dollar to break above that 112, which would be quite a meaningful bit of price action there for the euro dollar, with further upside expected at that point. Those bond yields, we've seen the 2-year sit since the Fed made that decision to cut 50 basis points. We've seen the 2-year just pretty much move sideways. Ironically, we've seen the 10-year actually rally, only sort of to the tune of 25 basis points rally, but that creates a bit of uncomfortable market dynamics. But we've seen market commodity prices like gold rally. We've seen a lot of weakness in oil markets for another variety of different reasons, but we'd expect commodities more broadly to rally, and this is often due to there's many reasons for that. Of course, what's going on in China plays an important role, but the dollar weakening. Okay, so that is just a little bit of a breakdown in terms of, yes, we do have a market melt up. The reasons why the markets are continuing to push higher for us right now are very convincing reasons for this melt up to continue. We do appreciate in terms of valuations that they're very, very high, completely out of whack in many ways, but will we get further upside? For us, everything is suggesting that we will, unless we have reasons to change that particular narrative. But at the minute, we don't seem to have those. So what we can do for traders every day, and we look for these opportunities, is to benefit from this risk on trade, look for opportunities in the US indices, look for weakness in the dollar, and we might get a series of significant dollar weakness, not just over the next few days, but over the next few weeks and months. So there's a series of hopefully really decent, profitable trades to exploit off the back of understanding these market dynamics. Okay, so look, that just about concludes this particular broadcast. So if you have any questions about anything covered, I appreciate, we do appreciate that these markets are quite choppy and volatile and difficult to get your head around, and you get a lot of conflicting data. But we're really interested in kind of how can we capitalize on these market moves and these narratives, and that's what we do practically every day. But you may have further questions about something that we've said or covered. If so, just drop us an email at support@thelivetraderoom.com and feel free to connect with us. And we'll get back to you as soon as we can, of course. So that pretty much concludes this urgent market update video. We've got this melt up in full swing, and for now, for reasons that we've discussed over the course of this video, we think it's probably likely to continue. to continue. So on that note, thank you very much for joining us. Do stay tuned for our next video. And if you are interested in learning how to trade the financial markets, do please go to our website, thelivetraderoom.com, and do feel free to connect with us through the website there if you need. Great stuff. So from everyone here at the Live Trade Room, thanks for joining us as always. Do take care, and we'll speak to you next time. Bye for now.